Thanks very much, Julia. Manda Trautwein has done a lot of research on baby boomer business owners. She's the chair of William Buck's National Corporate Advisory Focus Group, and she joins me now in the studio to talk about baby boomers in business. How are you, Manda?
I'm very well, thank you, Peter.
All right, now tell us about William Buck's, of course, is a chartered accounting firm. I've known them for years. But you guys have made a study on baby boomers in business. What are the main findings of that focus group?
Well, basically, Peter, from my perspective, there were probably 3 or 4 key findings.
Yeah.
The first one was in relation to the timeline. Almost 50% of business owners that were surveyed as part of this survey said that they're looking to exit their business in the next 5 years. And 70% said that they're looking to exit their business in the next 10 years. Yet, more than 50% are startups who have never bought or sold a business before or who have never been approached by a potential buyer for their business.
So they haven't necessarily been in business all that long, and they're still trying to get out in, say, 5 or 10 years' time.
No, what we're saying is that they've been in their business
for a long
probably
time.
For most of their lives.
They're a startup, but they've been there all that time.
So they're very good at what they do, but they've never had to buy or sell a business before, so it's completely new territory for them.
Okay. Are they ready for that kind of thing?
Well, that's the scary thing. Yeah. Some of the interesting other statistics that came out of this survey, one of them is mainly in relation to valuation, where we found that many of the people that we surveyed said that their business is actually the primary asset that is going to be used to fund their retirement.
Often their superannuation,
Yes, but more than 50% have never had their business independently valued, and they don't actually know what they need to do to maximise the value of their business when they sell it.
Now, have you found out why they haven't had their business valued?
I just think it hasn't been a priority. I think
it's a superannuation. It's not their priority. That's crazy when you think about it, isn't it?
I think 60 is the new 50.
Yeah.
The baby boomers think that they're invincible. They think they're going to be around forever.
We will be. But go on.
That's right.
Yeah.
And so they feel young. Yeah. They have energy for the business.
Yeah.
And perhaps some of them as well have been affected by the GFC.
Yeah.
And so their superannuation savings outside of the business might have gone down a little bit, and they might have to work in the business for a bit longer.
Yeah. Okay. So, looking at what you've seen, what's the advice that you guys are giving baby boomer business people?
Well, firstly, they need to start preparing now.
Yeah.
They need to prepare 3 to 5 years before they want to sell their business, realistically.
Okay.
And even if they decide to delay the sale of their business, they're not necessarily going to be disadvantaged by the fact that they have prepared their business for sale. Because having gone through that process, their business is going to be so much better for it. And they're the ones that are going to be the main beneficiaries of that.
Okay, so 3 to 5 years, the first one. What's the next advice?
The second thing is don't treat the business as your personal piggy bank. Separate your personal finances from your business. Don't run your personal expenses through your business.
Which a lot of people do.
Absolutely. Yes. And pay yourself a market salary. Treat your business like it's a publicly listed company. And another way of doing that, for example, is to bring on board an advisory board of people that you trust who can have regular board meetings with you as though you're running a publicly listed company.
Yeah. A lot of people also are so important to the business that when you take them out of the business, it's not systemised enough. So is that another recommendation you're making, to try and get the business more systemised so it doesn't depend on the personality?
Absolutely. So as part of that preparation process, in that 3 to 5 year process before you sell the business, one of the things that you'd be looking at is minimising risks in the business. So you're trying to put yourself in the shoes of the potential buyer. And from a potential buyer's perspective, what they're going to look at is the risk-reward trade-off. They want the maximum reward for the minimum risk.
Okay. What other advice have you got for these people?
Get the right advice.
Yes. Yeah. Well, I was going to say that because, you know, when I'm listening to you, most small business people have an accountant.
Yes.
You're an accountant.
I am.
And I would say a lot of accountants don't get involved enough in their customers' business. They do the tax return because they're busy doing tax returns, but they don't get involved as a trusted advisor. Are you saying, if your current accountant's not doing it, dump them, come to us? Is that what you're saying?
Well, yes.
Yes, that's why I'm on the show. Yeah.
Well, there are people like myself who do this full-time.
Yeah.
All I do is help people buy and sell businesses and value businesses. So I know how to do those things. I don't prepare tax returns. I don't prepare sets of accounts.
But in a certain sense, if you've got a good accountant who is busy doing tax returns and he or she realises you need this sort of thing, he should be contracting out less other people to do this sort of thing. In terms of valuing a business, what's the rule of thumb? You know, I'm making a net profit of, say, $1 million. What will I benchmark? What will I hope? Is it 4 times, 5 times, you know, my net profit, or what?
It depends on the business. It depends on the risks in the business.
Yeah.
My rule of thumb would normally be a multiple of about 3 to 5 times EBITDA, which means earnings before interest and tax.
Yeah.
And depreciation.
Okay. Of course, there are some businesses, like for example, financial planning businesses were paid 10 times when banks were being stupid. But it does vary. But you think of 3 to 5 EBITDA is a good starting point.
Yeah. And the thing about financial planning businesses, as an example, is that they obviously have a very high level of recurring revenue.
That's right.
The revenue is quite sticky.
Yeah.
So the people that they've prepared financial plans for this year are likely to come back next year to get their plan updated, and that's why a financial planning business might sell for a higher multiple, for example.
Okay. Any other? We're running out of time. Any other advice you want to give before we say arrivederci?
Preparation is key. Start as soon as you can.
Okay. And I guess, in a sense, like all businesses know, you should have a plan to grow your business. You're saying you should have a plan to exit the business as well.
And part of that plan will be to grow the business in any case.
Of course. So you get maybe 5 times EBITDA.
Hopefully.
Yeah, Manda, thanks for joining us on the program.
You're welcome.
Okay, that was Manda Trautwein from William Buck. Coming up, Patrick Lindsay from the Kokoda Track Foundation on what motivates people to take on this exciting and gruelling challenge.